And Mara, great, thank you. We'll just get you that. I'll unmute you there, Mara.
Perfect, thank you. I mean, I guess the main thing I'd comment on is the speed of the implementation and the fact that they ignored Treasury advice, and they haven't really looked at the impact on people like renters and what this might do to them in the long run, and whether or not this actually will gain revenue, or whether or not it will do anything more than shift property investors into new builds rather than push first-home buyers out of new builds. So there's a whole lot of issues around that we've yet to see any thorough analysis on.
Appreciate those comments there, thank you. And I believe I saw Grant's hand up there as well.
Yeah, I think the changes are good for at least three reasons. I think it should dampen the exuberance of the market, which should make New Zealand property at some stage more affordable. The OECD brought out some housing data about a month ago, tracking all the countries in the OECD from 2000 to 2019. The average over those 20 years was 39%. It would be fair to say that I think everybody knows that we're in the top half of that average. I don't know if anybody would have any idea what I think that New Zealand actually managed to achieve house price-wise, but we were first by miles. We're 177%. Canada, which is described as a poster child for property exuberance, was a very sad second at 147, and Australia was back and forth at 110%. Very hard to justify that sort of price increase. I think it also brings rental property into line with every other form of investment in New Zealand. I think that that's sensible. And I think it should encourage, as Mara pointed out, investment in new building.
Okay, good to hear those.
I wasn't sure that I said it would encourage investments. I think new builds are pretty much capped out in terms of capacity at the moment. I just said it might shift the mix of people in there from first home or home buyers into properties. I'm yet to see stats suggesting it will increase new builds.
I think that what they've done is relatively clever, but it's, I think, a bit late. They could have removed negative gearing like they were going to a couple of years ago and not added some of these other draconian measures that they've done. But because they let the market keep going, despite threatening, they just encourage people to game them. That's what happened. Now they've been forced to put a cork in the bottle. And I think that that's why they've done what they've done.
Good to hear those comments. So just Adam, you got a comment here.
Yeah, I feel that though the LVR, I mean, obviously back after COVID, the lockdowns, interest rates were reduced dramatically. LVRs were taken off and away people went. Investing in property and getting in. And the LVRs that were coming into force at 40% were starting to take effect. We were seeing buyers running around with pre-approvals where it was going to expire and they just wanted to buy something. And that was helping to inflate the last part of the last quarter, at least people were running around trying to do that. And that was going to take an effect on its own. It was already starting to happen and starting to ease off. And you could see that coming. And that's a tool that they could have, and a lever that they could have kept pulling. They could have turned the LVR up to 45, 50%, 60% if need be, and then they can take it back again. That worked in 2016 and that period when the market cooled off. So to target property investors as a specific investment class and say you can't claim interest on your business, it seems a bit tough.
I actually think that what they've done is sensible. Somebody that's owning a business, such as myself, can claim interest costs inside the business, but I can't take those costs and then claim it against my own income. That was the big difference with look-through companies and the old negative gearing regime. It just didn't make any sense. And the only two countries left in the world that had negative gearing were us and Australia. It's just crazy that that was continuing. It really was. It was just encouraging investment in what's essentially a dead area from the point of the economic development for the country.
If you run a business in your own name, you claim the interest. If you run it in a separate company, you can't. That's no different to property.
No, yes, it was, because you could be earning a salary and you could own a rental property on the outside, and then you could claim the interest against your salary.
But if you have a salary in a business, you can still deduct the interest in your business, so long as the business is not in a separate legal entity.
That's right, but it's not me. Like I can't employ myself, have a loss inside my business, and then artificially create a loss by paying myself a big salary, and then wiping that salary out with tax losses. It's just crazy. It becomes.
Was just as an FYI then, to those of you who are doing that, you probably need to talk to your accountant. We might just to comment at this point, Miles. From your client base, what have you been seeing? Have you been seeing sort of panic from that, or people are not too phased? What's the impression you've been getting?
I'll take a bit of a contrarian view to that, because there's a social issue to this, that the New Zealand government hasn't been providing social housing like you'd see in the UK, Australia, and a lot of the Western countries. So by allowing private investors to buy investment property, we're effectively providing the capital for the rental industry and a lot of the social housing that the government would normally take responsibility for. That's why we've been given the tax break. I feel that the measures have been very draconian to the mum and dad who want to invest maybe one investment property or two at the maximum. If they'd left those people alone and then targeted the property investors who are looking at 25, 26, and I know people 40, 45 investment properties, that is a business. That's quite a different structure. And that should be treated differently, I believe. From a view from the individual investors, I predominantly have been doing new builds because I feel it's a better proposition for the client. The investment has always been with a 7 to 10 year horizon minimum. So the bright line test really hasn't affected my clients. And the tax deductibility I've always treated as a bonus. You don't do it for the tax deductibility. And if you find that your cash flow is so tight that you can't manage it without that tax deductibility, I would caution the client and look at them to buy something smaller, which would carry a 7 or 8% interest rate down the track, regardless whether it's tax deductible or not. So I understand why the government's trying to slow the market down, but I agree with Adam. I was seeing the market start to contract anyway with the 40%. And it's a lot more flexibility if you just put in 40, 45, 50. You are then making a market where only high net worth individuals can invest in private property. I don't know whether that's a good or bad thing. But if you're going to put up the rates as they have, and I agree with Mario, all I can see is rents going up, because the mum and dads who can't afford it will put the rent up, or they'll have to sell the property. And now we end up with a smaller rental market. The rental rates are going to go up. It's just, I don't think it's been thought through at all. It's been a knee-jerk reaction to, we've got to do something, and they did.
Good to have actually these different views, because that's the whole point, isn't it? Across the country, we've got a selection of different views, and we appreciate sort of hearing your thoughts there. You've already commented a wee bit on issues that you foresee arising, but our panel, do you have any sort of further comments perhaps on the sort of issues that are going to come out of this big change? I think one thing I'd certainly agree with Miles is that if you can't claim your interest, and gradually that's going to be reduced, from 12.5% deduction this year, 75 and so on, then the money's got to come from somewhere, and so rent rises are perhaps inevitable. But are there any other comments?
And Gareth, what we're already starting to see is some of our landlords who are good investors who are looking after the tenant really well and have done over many years, who have maybe had the property $30, $40, $50 a week under market rent, are starting to look at us and say, look, at the next opportunity, can we get this back closer to market rent now, please? Because we're going to need that extra cash.
Adam, just a question: is that coming from because they don't want to see, say, some huge rent increase, which then looks ridiculous because it's been they've said keep it 50 below or whatever. If they wait, then they just can't come to, okay, we're going to put the rent up $200 a week and give the person a heart attack. So is it also coming from a bit of that?
Yeah, there are a couple of owners I've even spoken to this week who are probably $100-$150 off market. So we've had a long-term tenant for 10 years. And we're now putting a plan in place where we can start to increase that over the next few years, because of course now the government's introduced you can't increase rent more than once a year. It used to be you could do it every 6 months. Now it's once every 12 months. So you've got to look at that strategically as well as to how you time your rent increases and when it might happen. And and we're trying we're seeing out there in the market that there's still really good demand for rental property. So that's still there. But the owners are now wanting to try and get, most of them try and get the better dollar they can. Like Miles had said, your Mara and Para invest with 1 or 2 properties. Because they've also got a bigger bill, more costs right at the moment as well around the healthy homes aspect that's been coming into play. Some of these owners are having to sell their 1 or 2 investment properties because either A, it's just going to cost too much to get it compliant, and they may then pivot back into new builds or something like that, which should be the way to go. Or they just leave the market and instead of having 2 or 3 investment properties, they've now got just 1.
Okay. And I know certainly a lot of our investors, most of them, our clients are Mara and Para investors with just 1 or 2 rentals. Mara, you've got a thought there?
I definitely second what Adam is saying. From the accountants we've been talking to, their clients in the property market are looking at putting up rents. It is very likely that the government will end up getting more tax out of this. These people will not be deducting, or landlords will not be deducting interest. They'll be raising rents. They will be paying more tax, but the burden of that tax will be on renters who can't afford their own home and are paying high rents as it is. So I don't think that's worked. The other thing is, it's hard not to see this as a revenue gathering activity with the speed of implementation and the fact that a better lever to decrease house inflation is really changing interest rates. And so the landlords that I've spoken to have said, actually, if it's a choice between changing interest rates up from 2.2% up to 2.8 versus removing interest deductibility, I'm not 100% leveraged anyway, and I can put rents up. Actually, this is better off than alternative mechanisms that actually would have been more effective.
Interesting to hear that. Just Kevin, I wonder if perhaps we just pick your brains because as a property investor yourself, and with your years in the industry, just in terms of advising people on risk, do you see that is this increasing risk for rental property owners? What's your take on it there?
I don't know that it's increasing risk. I'll tell you what happened today. I was with some people that actually have got $2 million worth of debt, and the way their mortgage was structured, and it's just coming off. Their rate was 4.9 on that $2 million. Now, not that I do a lot of mortgage broking, but I'm pretty sure that through our network that's going to come close to the 2s. So when you look at that level of debt and based on that, I think a lot of people who are property investing must be taking that into consideration as well. Surely, is that money is so cheap at the moment. For those that have been around a bit of time, I think my first mortgage here in New Zealand went up to 21%. So to go and borrow $2 million, and I still think property is still a good investment. But like everything, you've got to do the numbers. Yeah.
And Kevin, what's the alternative as well? If you're not going to get ahead and to save for your retirement, what are you going to do? Are you going to put it in the bank at what 0.75% or
Well, yeah, I know, and it becomes a pretty broad subject. Not everyone in New Zealand wants to go to the share market or wants to really hike into the aggressive growth funds and the Kiwi savers and be investing in Bitcoin and all that sort of stuff as well too. But I think it's got to be horses for courses in here as well too. But Kiwis love property; they always have, and they always will.
And it's important they diversify, isn't it? Though still, they've got to have a good, managed fund and Kiwi saver, and but with some property as well, which is what they just say. You can go out and still hug it and touch it and know it's still there, regardless of what's going on out in the world.
I think Kiwi saver in its raw form is fulfilling that role, but for probably 70 or 80% of the population, that they're not investing and they're not really making these decisions. And this is, this forum is just a really great forum for people to take a balanced view on, whether getting property is good for them. The changes by the government and sort of saying, well, don't own an old house, own a new house. I'm not sure that this is actually helping fulfilling the need of a market which is still not producing enough houses.
Maybe just it's good to hear those comments there. In terms of perhaps from Grant or Miles, do you think that we're going to see more of a push into the managed funds and share portfolios and things like that? Is property going to have some of its shine, or has some of the shine gone off it as a result of these and recent changes?
I think you go, Miles.
Okay, just reflecting on, I've worked in the Australian market as well. It's quite common in the Australian market to have geared investments. So you're borrowing against your property at 2 or 3%, investing it in a growth fund, which may get you over time around 9%, and your interest is tax deductible. So there's a good chance that is going to happen in the New Zealand market. But the problem or the challenge that I, as an investment advisor, have is that property people tend to want to invest in property, and to try and get them to change to a different style of investment is a challenge. Whereas if you're working in the same market in Australia, it's seen as one of the things you invest in. It's not your core investment. You may hold 1 or 2 properties, but you also would leverage into shares and look at other alternative investments.
Okay. Yeah.
The Australian market, though, has had a lot more. Oh, sorry.
Yep. Yeah, hold that thought just for a moment, Kev. We'll just get Grant's thoughts there, and then, please, we'd love to hear from you.
Sure. I think the New Zealand market is maturing as investors. And I think that this might push some people, but I doubt a significant number, to abandon property completely and go into other investments. I think the one thing that you can't do owning a portfolio of rental properties is to have exposure to international investments. They, by definition, and at the end of the day, New Zealand is around about 0.5% of world GDP. So to have everything in New Zealand, you're making a 200 to 1 bet that that's the best place to have your money in the world. That's unlikely. So what we've lacked in New Zealand is education on investments. Financial literacy in New Zealand is close to non-existent, and I think that's a far bigger issue than tax changes in the property market.
Good comments. And Kevin, can we have your thought there?
Probably just echoing the same thoughts. You may not pick it up, but my accent is Australian, and I moved over here 30 odd years ago. And I just think the Australian superannuation fund model has educated people, especially in Australia, just so their financial literacy is a little bit broader in their understanding. And as people say, this market is only, just starting to mature here. So.
All right, I think Kevin, your internet has just died on you a moment there, but thank you. That's a good comment there. Question for our panel: what about interest rates? Where do you think interest rates are going to go? Is this going to have a big change, a big effect on it, or really in the big picture, these latest announcements are just a tiny blip? Any comments you'd like to offer on that? Maybe Grant, could you get our ball rolling?
Yeah, I don't think this per se will have any effect on interest rates. The interest rates are very clearly in the hands of the central banks in the world. Our central bank governor, I like a lot, but he is a very, very dovish dove. And so he will not move before his colleagues around the Pacific move. And there's no chance in Australia that they're doing anything. They've actually got a lower OCR than us, they're 0.1. The US, the Fed, have said that they're not touching interest rates. Everybody's happy to let inflation go. And if you look at what the Fed dot plot, so what the Federal Reserve is, like, poll their members every time they meet on where they think interest rates will be next quarters out for 5 years. There's no chance of the Fed funds rate going up for 3 years at a minimum. So we're in exactly the opposite position where we're in the late 70s with the Volcker rule. So what Volcker introduced was you raised interest rates to kill inflation, even if it wasn't there. We've flipped that on its head. We're going to let inflation go, and we won't touch it until it's very clearly way above target. That's a completely different way of looking at things. Eventually, we will have to pay for this, but in the meantime, interest rates go nowhere.
So, is, in some ways, a good time for borrowing wherever our investments are. Maybe they're borrowing to go into shares, into managed funds, into property, or whatever the case may be. But probably there's never been a cheaper time to borrow, and it's going to stay like that for quite a while, which is perhaps a little bit of a bright note on the horizon. One thing we've noticed is that a bit like, I think, your comments that you'd made, Adam, and Mara, just your own comments, just brings to mind some things you'd said, was for some people, it's not going to make a big difference because maybe they've got $400,000 or $500,000, but that's only costing them $8,000 or $9,000 interest a year, which is sort of, in the big scheme of things, not much. They've got a few losses up their sleeve, 3 or 4 years roll down. By that time, they're probably going to sell anyway and perhaps get into some new builds, something like that, and whatever else they may have in their portfolio. But then we've had others say, well, look, if I'm holding the property and then I decide to sell it in 10 years and I have to pay 50 grand tax, but I made 500 grand, well, that's just part of the price of doing business. I'm not worried about that. And so maybe in your discussions with others, in your fields and in your professional life, you've been hearing similar comments. What's been coming back from people as you've been talking to them?
I think most of our clients there's initially a bit of a flurry of concern and worry, but that, as you've said yourself, Gareth, that sort of calmed down. And I think with interest rates forecast to stay low, and if they stay as low as Grant's saying, that'll be fantastic, but that'll hold the investor in, and they'll stay there, and they'll play out the long game. I mean, and by which point do the rents help? They go up a bit, quite a bit more than maybe was forecast, and then the numbers start to work a bit better for them to maintain it. Still a little bit of capital growth here and there, a few percent, they'll hang in there, which would be good. If a whole lot of landlords started to want to sell their investment properties, then there is going, and without new purchase coming in the top of the funnel, especially with the lack of land and the lack of building supplies and all those sorts of things, then that would have an extreme pressure on rents upwards, which wouldn't be positive overall for society.
Right, thanks, Adam. Mara, your comments?
I would say as well, it's interesting that the government chose to wrap this package up with increasing the bright line to 10 years. As Miles said, the average duration that someone holds a property tends to be about 8. So all this really does is increase the lock-in effect so that there's less of a liquid market. And if you're trying to get property investors to get out of it so that there's more homes for homeowners, that's not consistent with that philosophy either. And the second thing I'd say is, again, the tax agents like yourself that I've been talking to, the people who are really impacted by this are the people who have one property, their entire investment, and the interest deduction is a big proportion of the cost for them because they're not running it as part of a bigger portfolio. The wealthier people who can afford more are going to keep their properties, which are still making a profit. They've got the cash flow and do okay.
Yeah. Do you foresee, panel, just things I'm reading in the news? My brother-in-law, he needed a new tire on his car over the weekend, and he said just to get the tires for his car was quite a major undertaking. And so we're starting to see this supply chain thing bite in all sorts of places. We read recently about, I think Carter Holt Harvey's decision, they were not going to supply to Bunnings and Mitre 10 anymore, etc. Do you see these sort of things as having an impact, that new builds are all very well, but problems with tradies, problems with wood, problems with land, problems with getting things through council, that we have sort of multiple things perhaps causing a bottleneck? Is that a realistic comment? Should we be concerned?
I think one of the things we haven't sort of built into this is, if I say it, the New Zealand Prime Minister's effect on the international stage. New Zealand is going to be a destination that most of the world will want to move to. So when COVID has been cleared through, we will not have, we'll be putting the gates up basically to stop people coming in, as opposed to going out to try and find people to come here. And that's going to cause a huge housing crisis on top of the one we've already got. So I think this, unless something's done about the Resource Act and more land is made available, I agree with Mara. I've already had clients, because as I mentioned before, a lot of my clients are doing new builds anyway. The problem I'm having now is finding land for them to put a new build on. And we're now going, well, definitely outside of Auckland, outside of Hamilton, outside of Tauranga, we're now starting to look like places like New Plymouth, Taupo, Palmerston North. And again, there's not a huge volume of land available in those places, but there's still a demand for rentals. If you build a rental, it's occupied the day that the code of compliance comes out. So there's a bigger issue down the track. And just on the comment you made there, the US has predicted that the backlog of orders and demands is going to make the share market over there in the next 12 months just boom. Their returns will be huge because there's such a demand, and we were feeling at the other end because the supply isn't coming through. So it's going to be an avalanche, I believe, in the next 2 to 3 years.
Okay, so given those,
the share market may be a place to look at because of that.
Right. Okay. And interestingly enough, perhaps just a thought, some are sort of might dip their toes into the water with sites like Sharesies and so forth, which has been great at getting people to just see what it's about without perhaps having to invest large amounts. But then it probably gets to a stage where if you want to really get serious about something and you don't have all the time to research, etc., then you really want to be engaging with professionals so that you're getting, I guess, the right kind of mix, the right balance of risk. And it was an interesting comment you'd made there too, both you, Grant and Miles, just about New Zealand in terms of wealth generation versus investing elsewhere. Now, obviously, there's a little bit of tax complication, but in the big picture, that's what you get your professionals around. So it's never been a worse time to have your money in the bank.
That's right.
Yeah, okay. I mean, in some ways, it's nice hearing these comments because you're right. The initial was, oh, panic, and is this all bad news? Is it all good news? It's probably a mixture of several things, and it actually opens up some opportunities which have been good enough to highlight tonight. Maybe just a brief comment or any brief comments on rent controls. Is that likely to happen, or is this just nobody's going to touch that with a barge pole? Any thoughts there?
I mean, they've introduced at least a rent control in August, being that you can only increase your rents once every 12 months. So that's a part of the way. I know there's talk about, do you put a rent control on the property per se? So if you had a change of tenants during the year, then you maybe can't increase the rent between tenants, which seems outrageous. So I would have thought that's a separate relationship with the previous tenant, and the markets move, we can put the rent up. I don't see how that would, who that actually benefits if they do it that way. So yeah, why do property investors need to get another thing against them?
Mm.
And that rent control was brought in under the auspices of COVID. So whether it's now a political decision that you're going to bring in, and I'm not making a political comment, a socialist reform that says that all free enterprises controlled by the state, we're going to end up with quite a different sort of position than we did when we brought this government into place.
Okay, interesting. Do you think it's very likely? Any comments there on, whether that's very likely? We won't hold you to it. Don't worry, but just, likelihood.
No, I think there's zero chance of a true rental control. They'll get what they want through the changes they've already made without having an explicit rent control. I simply don't think they need it. With everything else they've done plus market forces, I think that they will let the market sort it out. They are an interventionist government. That letter that we saw Robertson write to Air New Zealand the other day was, I think, a bit of a shock for everybody. That they want to be an activist shareholder, which is extraordinary. That's not the role you would have expected from what we've had with SOEs in the past. But I think they're also very good at knowing where the line in the sand is. And because of that, we won't get real or true rental controls.
Okay, so no need to panic necessarily. Just perhaps before we go to our last question, we had Mauro, just wonder if you could just explain a bit, because we do, looking at, say, for our clients, most of them, it's not going to have much impact, these recent changes, until maybe 3 or 4 years out from there, and start to get then tax bills start to build up, etc. But other than paying IRD direct, can you just tell us about the other option, which in our view is always a better option, and just explain a little bit, because the law had to change to make tax pooling possible, isn't it? But what is that? Most people are sort of not that aware of what this is and how easy it is.
Well, thank you, Gareth. Yeah, so tax pooling really allows you to finance your tax. So TMNZ is the tax pool. We manage about half the provisional tax take in New Zealand. And what we do is we put down tax on every POV date that anyone might have. There's about 13 of them a year. And if people need tax, they come along and they say, oh, can I have tax from 15 Jan? I didn't pay my tax bill. And they can either do it proactively and we'll put it down knowing and earmark it for them, or they can come back later and we just charge them the interest from that date. And so if they don't pay IRD their tax, first of all, IRD frowns upon it and gives them late payment penalties and currently a 7% interest. If they come through us though, we pass them along tax that we paid at that date. IRD looks at their account and goes, oh, yep, it's a pooling arrangement, perfectly legit, that's fine. And we charge them between, at the moment, 3 and 4%. And the beauty of it is that unlike a bank interest deductibility, pooling interest is deductible. So, I can see a big move to that in that people use their cash flows and use it other ways to finance their tax. And we've already seen during COVID in particular, pooling is just, people are using, just thinking about tax differently as one different expense. The other thing is it's very unlikely in property, let alone in any other business, that your income comes in lump sums 3 times a year on your provisional tax dates, or twice a year if you're a GST payer. So we have a lot of people who pay weekly, monthly, quarterly, set up installment plans, and it's all just flexible, and you've got up to 22 months from your first POV tax date to pay. So and there's no other administration fees or anything. And I mean, Gareth obviously is very proactive with your clients in terms of swapping out more expensive types of funding for this as well. So, it's very, we have 60% of our clients are trusts and individuals. And then we have obviously up to the banks and the big guys as well. So, it's a really popular service now, and it's just growing in popularity. So we do see, as I said, over the last 18 months, just this surge in popularity. And one of the reasons we've been talking to agents about these rules is to see the impact, and, that they do see that coming through in the next few years, continuing to grow.
So really, those watching this tonight or the recording later can talk to your accountant, or they can just go to the TMNZ website and contact you folks direct about this. Is that correct?
Yeah, thank you. Yeah, so talk to us or talk to Gareth. But yeah, very, very keen to help. All of our advice is free. All of our quotes are free. You only ever pay the interest.
Okay, so that's good to know. There's a little bit of peace of mind in terms of tax, which can for many is can seem like a bit of an ogre looming. Just a question then to the panel at large. New builds, and then before we just ask you for your final observations, how do you think these changes that we've had are going to affect the new builders? Are we going to see, we've talked about the supply chain problems. Are we going to see a kind of a mad rush into new builds and so many that soon the market's going to be flush with new build homes? What do you think? Or is that, no, that would be lovely if that happened, but that's just not going to happen. Any comments on what's going to happen there?
Because I'm actually actively in that market, I can give you an observation straight away. 2 subdivisions that I've been introducing clients to, the land was sold by negotiation, or effectively the developer said, this is what it is, this is how much I expect you to pay, and there'll be a bit of negotiation around it. They now have gone to the next stage of development, and they're all now for tender.
Oh, interesting. So, Miles, can you just explain to those that perhaps have never bought land?
So a tender is effectively, they would get the land, a general valuation done on the land, and they'll say, okay, this is the site size, this is the services available, this is the valuation being given to you by our valuer. You tell us how much you're willing to pay for it. And I did a tender for clients. We tendered on 10 sites, and this was done with the Napier City Council. We were between 15 and 20% above market, and the client didn't get any.
Wow. Okay, that's fascinating. All right, disturbing. Adam?
And Miles, that next stage as an example, when is that going to be released and be able to be built on?
May. It's released in May.
Okay, that's not so bad. I know in sort of some of the stages in Christchurch and in Auckland, you're looking at developments are a long way out. Yeah,
2 phases. One in May and one in early spring for this particular developer. The Napier ones were end of April, and they all went. So how much they paid for them, I don't know. I said to the clients, 15 to 20% you'd think would be acceptable. Well, they certainly weren't.
And that's where the cost of the land going through the roof like that, and I think it's nationwide, combined with now the cost of the actual build itself, with the cost of supplies, cost of labour, that's going to make the cost of new builds so much more expensive as well.
That's right. And as you say, Gareth, one of the issues the builders have got is getting supply of product.
Now, something I just saw, I guess, on this new builds in recent weeks was a revision of the building standards, and there was sort of, I think, 3 ideas put out. Do we have them, below a certain international level on a par, or do we have them above? And the article in it might have been Stuff or the Herald was saying different comments. Oh, yes, that's great. No, that's terrible, etc. But of course, with the raising of building standards, I think the comment was, depending where it was, it would add anywhere between $4,000 and $15,000 to the cost of a new house on top of these land and supply issues. So it would tend to suggest that as much as perhaps we as property accountants are encouraging clients, hey, look, new builds is the way to go, it's not a, what's the word? It's not some sort of magic solution, isn't it? Wave the wand and bing, there's a new build 9 months later, because there are all these other issues as well. I'm not trying to depress you if you're watching this, but just being, would that be a fair comment?
It is a fair comment, and it's definitely worthwhile for your clients, Gareth, to say, well, look, I've got a facility in the bank. I've got 300,000, which I'd normally stick it down as a deposit towards a new build. Land's not available. I'm paying 2% or 3% for this new build. What should I do with it? Well, I think you need to talk to somebody like myself or Grant and say, what are the alternatives? And there are a range of fund managers out there who are giving good returns over time. So it's not a quick rich scheme. Invest for 5 years and you should get a good return on your money, well above what the banks are doing, which would be better than just not doing anything.
Okay.
And diversifying and spreading your portfolio.
Right. So not having your eggs all in one basket, as the old
Correct.
saying goes.
Yeah.
Okay. Yeah, very good. So again, like yourself, Miles, Grant, it's just a case of like go to your website, so Money Planners or Cleary Wealth Management. You Google, you turn up straight away, you chaps, and we just connect and get some dialogue going. Is it that easy?
It's that easy. Yep.
Any comments you'd like to offer there, Grant, on this?
Yeah, I think now is a very, very good time to be investing. Simply from the point of view that the world couldn't have got any worse than it did last March, and that's left a lot of opportunities lying around. And being on the buy side of assets is a very good place to be if you know that you're going to be selling them at some point. We've got really strange creatures in the world that will pay anything for assets because of the way that they're incentivized. In the US, for instance, there are things that are called SPACs, SPAC, which is special purpose acquisition companies. And these are very strange things that they only have one job, is to raise money and then at some stage leverage themselves up and take a private company public. And they're very incentivized to do this because if they don't if they don't achieve this in 2 years, they've got to give their money back. And last year they managed to raise $82 billion in the US. In the first 8 weeks of this year, they raised $82 billion. So this is something that's not going away. And if you're an investor in private assets, you've got these people on the other side that will pay just about anything to achieve their goal, which is to buy something. It's extraordinary. There are a lot of broken assets out there, and there's not that very many dollars chasing them. It's an extraordinary opportunity. So it is worth broadening your horizon. It really is. One just general comment, debt is very cheap at the moment, but at the end of the day, it is still debt. And if you've done finance at university, or you just think about it for 20 seconds or so, when you've got a business, the only thing that you know the value of is the debt. You can pretend that your shares are up 20% or down 10 or whatever. The only thing you know for certain that you have is X dollars of debt. And it might be costing nothing at the moment, but eventually you've got to pay it up. And that is the only note of caution that I'd make in this environment. Don't get carried away with debt.
Okay, good point. And I guess learning from the lessons of the past, interestingly enough, I read a very disturbing news article that the Bob is making a comeback, which doesn't really affect me too much. But the point of that was that the last time the Bob was in fashion was in the 20s. And following the exuberance of the 20s and then rise of nationalism and rampant consumer spending, the Depression hit the greatest war the world has ever known. So as you can see, that's why I don't have a Bob. There's possibly some other reasons anyway, but I guess the point is to just be a little bit cautious. Don't be crazy about debt just because it's cheap. Perhaps we can just get some any sort of closing observations that perhaps Kevin, Adam, Mara, that you might like to add to our discussion.
Yeah, and while I strongly disagree with the government policy, I do see the upsides in terms of encouraging diversification. And I do think, as Grant, Miles, Kevin, Adam have pointed out, that there will be a shift in the market a bit. And if so long as renters come through it okay, in the long run, these things will settle themselves out. We haven't seen as big there was a lot of angst around it at the beginning from people I spoke to, but doesn't seem to. I don't think it'll have a long-term impact on investors.
Thank you. And Kevin, as you're somebody who's dealing with hundreds of brokers throughout the country, and just your own long history in investment, any sort of closing observations, or advice you'd give?
I suppose on my side of the market, what we're seeing is costs go up a lot. And people are probably feeling that we know building costs are going to go up, but in my side, what we're seeing is medical insurance costs start to go up. We're looking at 30% increases in premiums in the last 12 months. And mental health claims have gone through the roof from the reinsurers. So we're, there's more than doubled or quadrupled the claims in the last sort of couple of years. So, just have a look at those premiums that you are and just understand how they can be managed as well, because it's significant for a lot of people.
And so, Kevin, I know certainly you looked at our insurance and managed to shave off $80 or $100 a month, which was made quite a difference. So again, is it just, we Google solutions, but solutions.gen, isn't it?
It is, yes. Fairly easy to find. Yeah.
Okay. Yep. No, that's good. All right. Thank you for that. That's an interesting point that I haven't heard anywhere else. Obviously about what's happening with insurance premiums. So a nice bit of insider info. Thank you for sharing that. And finally, Adam, any closing comments either from your property management hat, your real estate hat, or both?
How long you got? No. I mean, the real estate market is cooling. So that over the next few months is going to be, the reports will come out and it'll show that that's done its job. That's for sure. But in terms of the property investor clients, it's about, I think there's opportunities with the cost of money being so low for extended period of time, as Grant was talking about, for the next few years, hopefully. There's opportunity still to reinvest into their investment properties and add more value, create more equity within it, and then create a better home for the tenants, and they'll get a better return out of that as well. So that they've got an opportunity to start looking at that, and that's about getting good help and support around them through not, I guess, fretting about it on their own, but actually they talk to the good accountants, mortgage brokers, and financial advisors, and look at it as a general, contractors about where I add the best value, how much it's going to cost to put in a new kitchen, new bathroom, all of those sorts of things. It's maybe the opportunity to look at that rather than selling it and do nothing, like we've talked about, just to get out of it and not invest. Yeah, right. Yep. Okay. Very good. Well, thank you. Those have all been very practical and positive, realistic bits of advice and opinion, and certainly we really appreciate you all coming together. Now, again, you can Iron Bridge is fairly easy to Google, so you can do that, and you'll find the links for all of this great panel that we've had tonight so graciously join us are also on EpsomTax.com. We're going to put the blog and the video up so you can watch that at length. Well, again, certainly we want to thank our panelists for all of their time and giving that freely to help people out. That's very gracious of you. Thank you so much for sharing that with us this evening. Thank you. All right. Well, we'll bid you all good night, and until next time.
Yes.